Let's talk more with Shari Olefson, director of the Carnegie Group think tank and author of the book Foreclosure Nation. Let's talk about housing, Shari, because interestingly enough, Blackstone's chief, Steve Schwarzman, yesterday told CNBC that housing is a good investment even though prices are not rising as much as after the financial crisis. Do you agree with Mr. Schwarzman? Of course, you got to remember Blackstone does have about $90 billion in real estate assets under management, so they want the housing to work.
Right, absolutely. Well, there's no question that we're going to see home prices continue to rise at a slow but steady rate. And the primary reason for that is because we've got such low inventory, and that's expected to continue for at least the next couple of years, particularly if rates rise, because we know that folks experience what we call rate lock-in, meaning they stay put because they don't want to lose that good rate. Already we're seeing low inventory because of slow new construction over the past years. Folks like Blackstone's Invitation Homes have converted hundreds of thousands of units into rentals. And so we have a real inventory problem, which is causing prices to rise and will continue as the rates go up.
So what needs to happen to improve the amount of inventory that we have in the U.S. market? Does that just come down to construction workers and the developers making sure that they are given the loans that they need to build more, essentially?
A big part of it is going to be new construction. The builders are building for higher-end buyers, so we need to increase that credit box so the builders are confident that if they build entry-level homes, folks will be able to get financing for it. A lot of it is the entitlement process, which just takes a long time. The municipalities are not as willing to give up those entitlement rights as they used to be. But a big part of it in the coming years may actually be tax policy. For example, the capital gains exclusion, which allows folks to take $250,000 for a single person, $500,000 for a married person, and not pay taxes on that when they sell their home. Now, those rates were set back in 1997 and have never been indexed for inflation. And we know that a lot of boomers are actually aging in place, in part because they don't want to have to pay that big capital gains hit. We also know a lot of folks invested in real estate from 2007 to 2010 and will probably free up that inventory if they know they can get their money out without paying capital gains. So surely, as we move forward towards tax reform again, particularly after the presidential election, we want to make sure policy like the capital gains exclusion stays in place, maybe even, again, increase those caps and free up some of that inventory, because we know the inventory gets freed up from the top down. Sellers are not going to list their homes unless they know they have a place to buy and move into.
Shari, thank you very much for being with us. Shari Olefson, director at the Carnegie Group, a think tank and author of the book Foreclosure Nation.